everyone. I am Tearsheet's editor-in-chief, Zach Miller, and welcome to our inaugural sessions of the Lendex Talks on lending, credit, and data. I'm joined by Akoya's Rishi Kapadia, who's a product manager there. Rishi is a UK native who relocated to the US 5 years ago after a successful career predominantly centered around consulting in the financial services sector. While delving into the lending domain, he later shifted his focus to embrace the dynamic world of open finance. In his leisure, he finds joy in watching cricket, hitting the slopes for skiing, and rekindling his passion for golf. And we're here today to talk about the financial data evolution, unraveling lending in open finance. Welcome, Rishi.
Thanks, Zach. Thanks for having me.
And one day when we're in person, you'll have to explain cricket to me. I still don't get it after all these years, but I recognize the excitement around that sport. So let's just dive right in. We've definitely seen, it's something we've reported as well at Tearsheet, on the rise of data aggregation powering sort of personal finance management, PFM applications, use cases. Can you tell us, let's start there. What's behind that?
Sure. Yeah, let's start with PFM. So personal financial management use cases have been one of the main drivers in financial data access adoption in recent years. PFM apps allow users to track their spending, set budgets, manage their finances, and these apps typically, use financial data access to provide users with a comprehensive view of the financial situation. The data behind these apps tends to be the transaction data of a customer. So you're looking at a checking account, a savings account. Sometimes you're looking to liability accounts, which show loans, line of credits, and such. But essentially looking at the transactions and giving a view to, a holistic view to the customer on their financial situation. Beyond PFM, I think it's also worth noting, there are other areas where data access has increased significantly in its usage. And continues to make large strides in, and those are like streamlining the account opening, funding, and payment processes. So just to give you an example, picture this: if in the past opening and funding an account required submitting like numerous documentation. So if I'm trying to open a checking account, I might have to submit my identity and then address verification documents, along with setting up that manual transfer to really fund that account. So this in turn was, is very cumbersome and time consuming, and often it deterred people from adopting new and existing financial solutions or migrating over to existing financial solutions. And so thanks to Open Finance, we're seeing this evolution of data access APIs kind of drastically changing that landscape. And this has essentially just helped build and create those seamless and efficient consumer experiences. And so now, users enjoy this hassle-free onboarding experience without the need of this extensive paperwork and manual transfers, and, can get a full view of their financial history and situation at a click of a button. And so if you really think about it, it's the positive impact is twofold here. One empowers like the financial institutions to provide better services and drive the adoption of diverse fintech offerings we've seen in the market. And then secondly, we see it offers the consumers the convenience they crave. And this only builds the trust and loyalty towards these emerging financial solutions. So kind of a long-winded answer, but I wanted to take it back and also include some of the other use cases we've seen in that space.
I'm glad you mentioned that, because I think that account opening and funding and sort of that user experience layer is one of the most exciting when it comes to data aggregation, one of the most powerful. Obviously, it is data aggregation is powering other applications, like we're seeing it more in lending. But I think there is a tremendous, like very visceral feeling when you have a good experience that's powered by data underneath it. So let's talk about lending. So we're seeing that as well. We're seeing that PFM is now becoming Open Finance is empowering lending applications. So data underscores all of this. Can you tell us more about that market shift and the use of financial data aggregation specifically towards lending?
Sure. So in recent years, there's been a growing shift towards using these lending use cases, and there's a number of factors, and let's go into the first one. So The first piece is, more FIs are providing access to this consumer data, and this is being aided by core processors. So those who are providing the access to the long tail accounts in the market, and this is truly due to the growth of open finance, which allows users to share their financial data with third-party applications like fintech apps. A great example of more access to consumer data, I'm just going to take the example of Akoya. We initially started with just the large US banks and started to gain the data coverage amongst those. And now we've integrated and continue to integrate with more core providers into the mix. And that really captures the long tail coverage that folks need, because often they're working with one big bank and maybe some credit unions, local credit unions or local banks. And so you'll see kind of greater confidence from these financial services organizations in adopting these aggregation services. And so one other thing to add here is, Akoya's direct connections provide a reliable and secure connection, and such advancements has really like propelled that confidence in lenders to opting to use this financial data. The second point I want to make is we're seeing a shift towards lenders leveraging open finance as they're under increasing pressure to make those accurate lending decisions. And this is due to two things. One is, there's increasing competition in the form of digital lenders and traditional lenders, and all are innovating. So you have BNPL, so buy now, pay later, you have digital personal loans, traditional personal loan lenders, and digital mortgage lenders. And some of the digital mortgage lenders have, taken a large market share today. And so that's one of the reasons. And the second one is the need to reduce the risk of lending to borrowers who are likely to default on a loan, and especially with these tightening economic conditions we're seeing.
Sure.
Having additional data helps to supplement those underwriting models that they have in place today. And then finally, financial data access is or can be used to develop new lending products and services. So we're seeing, lenders often tailor products to the specific needs of borrowers. For example, thin credit files we've seen, or those who've been excluded from traditional lending markets. And this has been made possible by looking through, the detailed transaction history of a borrower and enabling cash flow underwriting models in the market. So to kind of sum that point up, the future of financial data in lending is definitely bright. And, as the availability of financial data continues to increase, we're seeing, more need for this accurate lending decisions becoming more pressing there. And financial data access will become increasingly important in the lending process. And again, as fintech industry grows, data access remains like the forefront of that innovation. We'll start to see products eliminate the customer's friction.
I want to ask you an in the weeds question, Rishi. What are the benefits of using OAuth connections for lending data specifically?
Sure. So OAuth connections are really a secure way for lenders to connect to the financial institutions to access their customers' data. At Akoya, we have 100% OAuth connections to the financial institutions, and in turn, you gain unmatched data reliability and accuracy. Essentially, OAuth connections use tokens to authenticate users and grant them access to those data APIs. So you do this without ever storing or sharing the customer's user login codes, and this essentially helps protect the privacy of a consumer's financial data. OAuth connections or OAuth API connections, are generally easy to use most of the time out the box. Lenders can, start to integrate with these APIs very quickly, and they're often very developer friendly. Essentially, at Akoya, we aim to be as developer friendly as we can be, and it makes lenders. It gives them easy access to get started with the financial data access and start to make those informed lending decisions. And then finally, like the direct to bank API connections is another part where Akoya has been focused on, and that essentially just ensures reliability in the data access, because you're establishing like a direct and secure connection between the data access network and the user's bank. And so you're bypassing any intermediary or third-party services, and it's kind of minimizes the risk of data discrepancies, delays, or potential data breaches, which you might find with methods of like screen scraping.
Mm-hmm. One of the things that we're seeing on the lending side is that with open finance, like really it has acted as an engine to help enable sort of specific use cases within lending. And I have to make an assumption, it is just an assumption, that like cash flow underwriting is the most common lending use case. Is that correct?
All right. So, I mean, historically, lenders were limited to using traditional credit scores and other credit reporting agency data points to assess a borrower's credit worthiness. I think as open finance has evolved, given the access to more data, lenders now consider a borrower's entire financial picture and includes income and expenses. So cash flow underwriting is definitely a great example of this, whereby I'd say the income and expenses are analyzed to determine the creditworthiness of customer, often with a thin credit file. But I believe cash flow underwriting is still in its early stages. We've seen cash flow underwriting being adopted by the fintech lenders, and they're definitely using that data to serve a broader segment of borrowers with like a differentiated offering. But with the larger FIs, we're seeing slower adoption for these cash flow underwriting models to supplement or replace their existing decision models in place. So to really answer your question, no, I don't think cash flow underwriting is the most common lending use case, but it is definitely a growing segment we're seeing and keeping an eye on.
That makes a lot of sense. And I think, yes, we're also seeing cash flow underwriting like on the consumer and on the small business side, which I think is interesting as well. And it sounds like there's a lot of room for growth there. What other use cases are you seeing in lending?
Sure. In recent times, in the lending industry, we see a growing reliance on financial data APIs during the customer onboarding process.
Mm-hmm.
So this shift aims to, I say, authenticate a customer's income and assets during the onboarding process. So it eliminates the need for those conventional methods, such as uploading the bank statements and other documents. And so this transformation basically streamlines the loan approval process, making it more efficient and user-friendly for customers. So let me give you two examples. One is in the context of a personal loan application. So one of the pivotal steps as part of the loan application is verifying a customer's income. When you think about personal loan, and if you were to submit a personal loan application, you are required to input your income information. And so as you input the income information, that input is usually compared against the data points provided to a lender by its conventional lending data. And so that data usually comes from a credit reporting agency. And should that figure align with what has been input by the customer, there usually isn't any further inquiries on the income. So that's a positive customer journey. On the flip side, if we look at where there is a disparity with the declared income and what the lending data has posted, usually the customer is asked to furnish some supplementary documentation. And this documentation could be in the form of bank statements, where they then look through the bank statements to identify the income, or it could be your tax payroll statements to see what your income has been for the past 6 months, 12 months, and such. However, with financial data access, you see it being used as a facilitator in this. So the mechanism essentially empowers a user to establish that secure connection with their respective banks. This connection in turn empowers the vendor to extract the transaction records, which are intricately linked with the customer's income. And then they automatically calculate in the back end, what has been the stated income, and does the actual income map up with that customer. So that's one great use case we've seen, especially on the onboarding process. A similar I would call out is in the mortgage application process, where you have to validate. So when you're applying for a mortgage, you have to validate that you have enough money for the initial payment, which is the down payment. This could be 5%, 10%, 20%, depends on the loan type you are asking for. And so, again, before this was done by looking at statements, but now the market has products which are called asset reports. And basically, it summarizes your customer's financial details, including how much money is in their account on a specific date, the transaction history. And so the underwriter is really able to validate this information and confirm that there are sufficient funds in the account to process this loan for approval. And so this makes the mortgage application process smoother and clearer for everyone involved. Beyond onboarding, there are some other areas where lenders are using financial data access. So let me kind of touch upon a few. Credit scoring is definitely one of them, where they use the data to develop their own credit scoring models. Again, this comes back to the accuracy point and tailoring underwriting for those specific products that they are building for. The other one is fraud detection. We see this a lot in the market. Fraud detection. Lenders are using that data to just identify fraudulent transactions, and this protects both the lender and borrower from any financial losses. The most interesting one, I think, is risk management, and we haven't seen a lot of this, but I think we'll start to see a lot more of this. Lenders are able to continuously monitor the borrower's financial behaviors, and that's during the loan term. So if there are signs of financial instability or risk, lenders can take those appropriate actions and adjust the terms of the loan, or maybe offer financial guidance to their customers. And I think this is a really good use case because it really tailors the services for the customer. So being more customer centric and essentially holding on to that customer for a longer period of time, and being maybe able to upsell some other products to them post their loan term.
I appreciate those point solution examples of how open finance is powering new use cases in lending. I'd love to zoom out a little bit. Can you tell me about how open finance facilitates sort of the whole user experience in the lending process?
Sure. So open finance provides borrowers with more control over their data. So borrowers can choose which providers they share the data with. They can always revoke that access at any given time. And in turn, it creates like an additional level of trust for those consumers. And at this point, they know the documentation of their financial profile, which is sensitive documentation, is being transmitted through a safe and secure ecosystem, rather than the paper copies we might have seen historically many years ago, and the email scans we've seen more recently. And this kind of gives the customers peace of mind, knowing that they're in control of what data is shared and with whom and for how long. Additionally, I think the integration of financial data APIs is a game changer for both digital and traditional lenders. I think this point it often doesn't get considered with lenders, but I think when you're in the lending space, conversion rates are huge to you, and through the use of streamlining the verification process for let's say income, and also the mortgage application, where we said asset reports helps them identify the down payment. It reduces the friction associated with these traditional document submissions, and customers are more inclined to complete the loan application rather than stall halfway through the application. And so lenders are really seeing a higher conversion rate, or successful conversion rate, and that leads to increased business growth, but also customer satisfaction. And so to conclude my points, I think I believe financial data APIs are improving the end-to-end flow of a customer's journey. So from the application stages to getting the approval, to actually servicing the loan as well, and paying off that loan, so through disbursements and whatnot. So I think that's the flow is it's improving every layer of that journey.
Definitely. And Rishi, we're getting, I think we have time for one more question. I'd love to look like out into the future. What is your outlook on lending and open finance in general?
Sure. So I think navigating the lending landscape is especially in the context of open finance and data integration is it presents significant challenges. Look, the lending industry is under stringent regulations, and then there's emphasizing the necessity for compliance. And particularly when you're automating processes like income verification, asset reporting, look, as you delve into this arena, it's evident that the demand for direct to bank auth connections will surge among like lenders. I think those who intend to harness like the capabilities of financial data access services, they'll look for uptime, high uptime, and dependable connections. And then in addition to that, I think um, there is the need to or the importance to source directly from the banks, and this shift kind of aims to mitigate some of the risks associated with the maybe inaccuracies of data capture through methods like screen scraping, for example. So I think the financial institutions are really going to transition towards more direct sourcing, which kind of aligns with the enhanced accuracy and reliability that they need to run their underwriting models. And then finally, this evolution is not limited to a singular purpose. I foresee broader spectrum of use cases emerging, like I mentioned, through the entire journey. I think loan application, customer onboarding, servicing the loan. We haven't seen much of it, but I think we'll start to see some of that, and then finally paying off those loans. And this speaks to the industry's intent to streamline and fortify every step of the process, ensuring one, efficiency, transparency for your customers, and ultimately, a seamless experience for both lenders and borrowers. More importantly, borrowers. And at Akoya, we're tracking on all of these emerging trends, within the lending landscape. We're working towards, prioritizing the build of specific solution and those that the customers want and need the most, and also solutions that save the customer and lender valuable time and effort, and also money. So that's where I see this the open finance for lending go.